Okay, so again, let me ask you guys this question. Who here from Giselle's team actually knows what moves the foreign exchange market?
Wait, what moves what?
What moves the market?
Institution.
Institutions, okay. Institutions like what?
Banks, governments, hedge funds.
Right. Okay, perfect. So essentially we live in something of a pyramid or a hierarchy of price in weight, right? So think about it like this. For the market to move up a certain amount of points, it has to have a certain weight behind it, right? So essentially, say there are 25 buyers, right? And there are 15 sellers. Where is the market going to go in this situation?
Buy.
Buy. Right? It's going to
Yeah.
favor buyers because there's more, right? That is essentially the core concept of supply and demand, right? That's very simple. That's very straightforward. You obviously know this. However, for every buyer, there has to be a seller, right? If there is only buyers, the market's going to skyrocket in one wick, right? If the market, plummets, sorry. If there's only buyers, the market's going to rise very unexpectedly, right? Like this. If there are only sellers, what do you think is going to happen? What's going to happen if there are only sellers? If there are 0 buyers and 100 sellers, the market's going to crash, right? Essentially, that's what happens, because the markets have to leverage themselves so that wherever there's a buyer, there's also going to be a seller, right? So as I was saying, we live in a hierarchy of price, and that hierarchy of price essentially works like this. There are different stages to it, right? At the bottom, there's going to be us, retail. We're the most numerous, but at the same time, we hold the least weight. Why? Because the banks don't really care about your $100 account. The banks don't really care about your $500 account or 500 or like 50K account. They don't care about it. Why do you think they don't care about it? Because they're dealing in the millions of lots, not dollars, lots. Okay, so retail's down here. We hold very little weight, but we have a big number, right? Now, does that really matter? Yeah, because we hold a lot of liquidity. Okay, now what else? Hedge funds. Above, we're going to put hedge funds, right? We're going to put everything that has a little bit larger capital, meaning what else? Smaller banks, right? Smaller banks. A lot of people have come across, in your trading career, you probably have come across people that text you on the side and say, hey, I can manage your account, but the limit is, like 100,000 or whatever. Account managers, right? Those guys are above retail because they have a lot more money. So as you guys can see, as we go up the pyramid, there's going to be more money involved, right? So up here, there's going to be banks, right? Now, these aren't institutional banks. These aren't larger banks. These are, the mid-tier banks, the ones that are responding to the higher banks, but also are, they're not as small as these local credit unions and stuff like that you see at your corner, right? But there's also brokers. Can anybody tell me what a broker actually does? Like, can anybody tell me how a broker comes to be?
Crickets from my end, because I don't know.
It's fine.
Oh, they just make a shit ton of money off us from them bullshit ass fees, spreads. Wow.
Yeah, true. But not only that. So let's think about it. A broker actually comes from a bank. It's owned by a bank, right? So KOT, Hugo, everything like that, they are owned by a bank. They are owned by the same bank. Hugo, Osprey, and KOT are all owned by the same bank, right? So essentially it works like this. There's the big banks, which are up here, right? These all make sub-franchises, which becomes the smaller banks. Now, some of these smaller banks are thrown offshore, right, to the Bermuda, to the islands, right, to everything like this, and then they start their own brokerages. Their brokerage, right, in this case would be Hugo, KOT, Osprey, right? Now, what they do is essentially they see your positions. They see the majority of their positions, right? So say in total, Hugo is dealing with 400 million lots. Let's say, for example, right? So this one's going to be worth 400 million lots. And out of those 400 million lots, there is going to be, say, 60% of them are in a buy, right? 60% of them are in a buy. What's going to happen when Hugo reports to its upper bank and its upper bank reports to its big bank who also trades? If they know that 60%, right, 60 versus 40, 60% of their people are buying and only 40% of people are selling, where do you think they're going to push market towards? Do they want to pay 60% or do they want to pay 40%?
40.
So they want to pay less people, right? So
Yeah.
if 60% of people are going to profit from this trade, they don't want people to profit. So obviously they're going to go short, right? Because only 40% of people are actually short on this position, right? Does everybody understand that?
Yes.
Yes.
Right? This is known as market sentiment, okay? Now, this is a confluence that you can use on your trades. It's not something that you should use only, right, to trade, but it is something that you can use in your confluence and your trades. You can look up on Google, right, say Euro NZD, IG client sentiment, like this. That's one of the world's biggest brokers, right? And essentially wherever they have the majority of their positions is you can kind of say where the majority of the world has their positions, right? So you can look up on Google, say like Euro NZD or GBP AUD, whatever the case may be. You can look at those and say IG client sentiment, and it'll take you to IG, which was a broker, right? And you can see, and whichever percentage is higher means that more people are in that position, and the banks want to go opposite to that. Right? The banks want to go opposite to that. Why? Because they're going to have to pay 60% of people if they win. So if TP gets hit here, the banks are forced to pay out of pocket 60% of their clients. But if only 40% win, the bank, gets to net all the stop losses of all these 60%. And they are more than happy to pay the take profit of these 40% of people. Okay? It's basic math. Does everybody understand that?
Yes, sir.
No, exactly. They don't want to pay anybody, and I'll get that. That is a very, very core concept of smart money. They don't want to pay anybody. They want all of your stop losses to get hit. So they already took out your stop losses. Now they're going to turn their sights on you, these 40%, and they're going to try to reduce this number as much as they possibly can. And I will get to that in a little bit. So let's go back to our hierarchy. After the banks and the brokers, we're going to get. So what do you guys think comes afterward?
Government or Illuminati at this point?
Okay.
So here comes in the big banks and what is known as treasuries, right? Treasuries meaning, does anybody have an idea of what a treasury is? We have one in the US. The US Treasury, right? How much money do you think the US Treasury has?
Whole lot.
A lot of money. So if they decide to also trade, they can also move the market, right? Now, above this, what do you guys think is the top?
Mm. Is this the last one, or there's another one after
This
this?
is the last one.
Someone says central banks.
Reserves, probably.
Well, those are part of the treasuries.
Ah, damn. Damn, I have no idea.
Governments.
I'll show you guys.
Don't say algo. The market maker. Market price algo. Yeah, I knew it's algo. Oh my gosh, how did I know?
Market price algorithm, right? That's essentially what it's called. This original term was coined by a professional trader, right? And basically, the market price algorithm is essentially how the market moves, right? It's essentially the core of the market. It's how supply and demand works inside of the market. Now, the banks know how to trade this, and they use it to their advantage. Essentially, all they do is they take price and they abuse the algorithm to make as much money as they can. But since they, dealing in the millions of lots, can move the market, there will be something called institutionally sponsored candles.
Mm-hmm.
Okay. Now, these institutionally sponsored candles may take months, years to be completed, right? Now, well, actually, sorry, that's a liquidity fill. My fault. So these sponsored candles, how many times have you guys come across a chart and this happens, right? Say you're going on GU or whatever, right? And you're steadily climbing and you get into a buy right around here, right? You're buying. And all of a sudden, it wicks down all the way down here, hits your stop loss,
And shoots right back up.
and then retraces all the way back up, right to your take profit. How many times does that happen?
Plenty of times.
Recently, but shit.
But nah, the way I got my stop losses, nah.
I stopped putting on stop losses because it felt like they were doing this just to piss me off out of everybody.
Now, how many of you guys can actually come up to me and tell me how big are your stop losses, by the way?
Mine is literally probably right underneath the order block or like 10, 20 pips below or above the order block.
Mine underneath the next zone so that the price would have to break underneath that next zone on a buy to take me out. Sometimes it's pips, sometimes that's 50 pips, sometimes I'm just like, fuck a stop loss.
Okay.
Sometimes I adjust the stop loss to make a tighter stop loss.
Okay, makes sense. Now, to all the people in Empire, let's give a chance to the people from Giselle's team to answer, just so they can they can be a little bit more personalized for the call. And for you guys, I'll do a call tomorrow, and we can discuss a couple more things in depth, like the Asia breaking range. I'll give you guys a treat with that. Okay. Now, continuing on, this happens way too much, and I'll explain to you why. Now, who here can tell me what liquidity is?
Those are the zones where the banks
Money?
orders.
Where profit is made.
Smart money. Smart
Profit.
money.
So liquidity is a pretty shady concept, right? A lot of people may not understand what liquidity actually is. And I'll give you guys a quick rundown of what liquidity actually is. Liquidity essentially is money, right? Like you guys just said it. Liquidity is money. Now, what do I mean by it's money? Well, it's exactly what it sounds like, right? So let's type this out. Liquidity is money. However, it's the amount of money that banks can use at a certain time.
Mm.
Now, and let me put in parentheses, also known as standing liquidity. Okay. Now, for some of you, you guys may be looking at this and saying, okay, but how do I look at this in a chart? Well, essentially, in a chart, liquidity is characterized by a couple things. And let me give you a couple examples, and I'll go back to the chart here. A lot of times, liquidity is known as candles, right? As wicks. A lot of times, wicks like this. Let me zoom back down over here. So let's look at this replay real quick, right? We're on the 2-hour chart. This is my favorite time frame. Let's look back at the 2-hour chart and let's see what happens. So we start our simulation and we see this. This right here, what do you guys think happened here?
Ran stops. People made profit from the sales.
Shot up, but then the bears really pushed it back down into a zone of consolidation.
Okay. All right, some solid answers. What about everybody else?
Just saying again, there was a lot of buys in that in that period of time, or there was like buys and sells going on. I didn't know what it wanted to do.
Okay.
Stable. Yeah.
So this is something called an institutionally sponsored candle. Now, why is this an institutionally sponsored candle? Essentially, because it went both ways, right? Now, how did it go both ways? Let's look at this from a different perspective. If you're a bank and you're trying to stop out as many people as you possibly can, and you're a retail trader, right? As many of us are, a lot of people put buy stops right here. A lot of people put buy stops here.
Oh, my bad, dude. Let that out. That's
Took all their money.
No, yeah. You have the absolute right to laugh. This is how we make money. But look, up here is exactly where a lot of people are going to be placing their buy stops. Why? Because they don't know how to trade any better, right? That's just how they trade. But the bank pushes up, triggers their stops, and what does it do? Their 30 pip stop loss, 40 pip stop loss. I've seen a lot of, quote unquote, professional traders have even 50, 60 pip stop losses. Clapped, right? All of them. Now, if we look at this as well, a lot of people are also going to have their sell stops right here or right here, right? Because why? Because they say, oh, if I want to be a breakout trader, quote unquote, right? I want to be a breakout trader and I want to catch every single move. They're going to go a total of 19 pips in profit, and then they're going to get stopped out. Why? Let's look a little bit further, right? We have this institutionally sponsored candle. Now, this right here, when these wicks happen, this is known as liquidity, ungrabbed liquidity, or untouched liquidity. Okay, untouched liquidity. Now, what do you think happens when we have untouched liquidity?
It got to get touched.
It has to be filled at some point, right? Now, does it have to be filled immediately? No. That's what a lot of traders fall into the trap of, immediately getting into buys, and they get stopped out, and they're like, why'd I get stopped out, right? So let's keep looking. Knocking out sell stops, stop losses. Price consolidates for a little, comes back up, comes back up, comes back up. And now effectively you have filled this liquidity. So now that you filled this liquidity, again, this is untouched liquidity. Why did it come back to fill it? Because banks want to grab as much what as possible?
Money.
Money, also known as
Liquidity.
liquidity. So now you guys are going to get into the habit of talking about different gaps, different wick fills, different stuff like this as liquidity grabs or institutionally sponsored candles. Now there's a very big treat for you guys that I don't know if any of your instructors or anything like that actually know about this, but this is volume down here, right? Do you guys see how this volume spiked as soon as this candle hit?
Yeah.
Quick tip for you guys that I usually teach my team. Whenever you see candles do something like this, most of the time, they're going to come back to that position, right? A lot of the time, like 90% of the time, they're going to come back to that position, right? And if you don't know how to put on volume on your trading view, go to indicators and literally just type in volume. And it'll be this one, volume. There you go, okay? Now, continuing on. Now that we have understood what liquidity actually is, I want to go back to something that is very basic to a lot of you, but it is very important. And if you guys see, the continuation of this point, we actually continued on upward, and I think we're only going to continue on upward. I'm going to go back to something that is very basic to you guys, but it is also very, very important. How many of you guys actually know market structure, like, and can define market structure for me?
I kind of see it like at the end of the chart.
At the end of the chart?
So
Okay.
yeah.
What do you mean by the end of the chart?
Like, I mean, just I would see it by marking up my like putting the line at the top, marking up my top 3 highest points. And if it breaks, I guess I don't know.
So let's say your quote unquote resistance gets broken. What do you do?
No, wait.
You buy immediately.
Buy
You
it.
wait.
No.
I'll wait
wait.
For
until
that, you gotta wait for that retest. No retest, no
You
entry.
wait. You wait to if order block is there.
Wait for the bounce.
yeah,
Okay.
Wait for the bounce.
wait for the bounce.
I'm hearing some good answers. Now, a lot of times people would say, you know, wait for the bounce, wait for an entry, wait for this, but sometimes it doesn't even give a re-entry, or it doesn't give another test. Sometimes it just drops straight down right into, like, how many times have you guys been super confused because you guys see this happen? Say this is your top, say this is your bottom, and essentially this is what happens. You know, you create your range, and then you suddenly break up. You get this, you never get the bounce, but how can you tell whether or not this is going to bounce? We'll get into that later. However, let's say it just does this and then shoots back up. A lot of people don't understand why it comes back to this point, but I'm going to show you why a lot of times price actually does tell you exactly where it's going, when it's going, and how you, as a trader, can minimize your risk and maximize your reward. Okay. Now let's go back a couple days, and I love back testing. That's one of the things that you guys will eventually learn about me, is that I absolutely adore back testing. I love it because it helps you see the market in such a different perspective. It helps a lot. Okay. So I'm gonna show this to you guys, and I want you guys to tell me what you see. Okay. So let's go ahead and play. So at this point, what are you thinking? You as a trader, however you learn to trade, it doesn't matter. However you learn to trade, what do you guys think is happening at this position?
I see that the market naturally technically wants to go ahead and rise up, but it does look like there are some couple strong tugs in the downward direction. I also see spikes of volume when it was moving down, so it looks like the trend is reversed. I see a ugly little doji right there at the top. So the market's going to want to get down to at least that 1.3045 area. Yeah.
Yeah, right by the
Okay.
order block where it was left. Yeah.
Okay. So let's say we short this position, right? What's our risk? It's almost 50 pips, 51 pips. That's a lot of risk, right? After you get all your confirmation, and let's say we put our TP at to 1345, right? What is it? Yeah, the 3045.
I wouldn't short it though.
A lot of people would. That's the thing, right? A lot of people would short it. A lot of people would short it. A lot of the times when I see a lot of different signals being sent out, they have risks of 50 pips and TPs of 60. Remember, guys, that everything in foreign exchange, and I know that a lot of people are going to disagree with me, but I know that a lot of others will agree with me. Risk to reward is everything in this market. I cannot stress that enough. Risk to reward is everything in this market. You cannot, and I stress cannot, focus on pips. Because if you focus on the pips that you're winning instead of the pips that you're risking, you're not going to be successful. So let's go ahead and continue the simulation. And of course, in this position, your TP probably would have gotten hit because I know that your stop loss never got hit. But that's not something that we want to focus on. We want to focus on the reaction upward because obviously, right, our position is still going to be bullish. So drops, right? Now it drops here and then it does this. Now, to all of the people in Giselle's team, and I don't know how many of you people actually are in here, but I want to ask this question to you guys specifically. What around this area caused this to happen?
That it went ahead and closed out that imbalance from the far left. It already tested the top of the zone there once. And then it kicked it back, cleared out that liquidity, like that dude in the messages just said. And it had a strong reversal signal with that doji showing that the trend was over on at least a 2-hour trend, and then decided to go back down to the next zone of support.
Okay, so in this position, what would you do? Would you short or would you go long?
I'm going long.
I'd take profit and watch, to be honest.
You take profit and
I'm
watch.
going long.
Okay. Okay. Who's saying that they're going long?
It's Deontay. I'm going
Deontay?
long on
Okay,
this one.
Deontay. All right. What about people from Giselle's team? What do you guys think? I want to exercise your minds here because you guys are going to see this position many, many, many times over. Think of it like chess. You're going to see this position a lot of times.
Well, seeing how it did test to the bottom of support right there, and the candlestick wigged down underneath, then came back up, and it consolidated on the line for a little bit before testing it one more time. It does pass test for a nice buy position, at least to the top of the support. I mean, the top of the zone where it hits resistance again.
Okay. So in this position, we would, you know, a lot of people are saying long, some people are saying short. Now, let's look at our risk reward, right? In this case, we would be opening right here. And then where would you put your stop loss?
At the bottom of that wick, not even
right here?
Body. Yeah.
No.
Where would you put your stop loss?
Right there.
I'm going a little further.
Right here?
Below the double bottom. Yeah, right before
here?
the yeah.
Okay. Okay. All right. What about everybody else? General consensus that there's going to be 2 stop losses, one right here and one right here.
I would put
And then
on
your
the,
take profit's going to be at the top here, right?
Yeah.
Okay.
I would put one.
So let me show you guys how to not have a 76 pip stop loss. Okay. It's very simple, but it's a term that you will eventually learn to love, and it's a term that you will eventually learn to master. Okay. And it's something called the order block. Okay. And to everybody in Empire, I have given you literally 5 classes on this. But to everybody on Giselle's team, this may be the first time that you've ever heard this, and that's completely okay. That's completely fine. But let me show you how people at Empire have learned this, okay? Essentially, what we say is, let's say that price is going to return to this zone. What I am focused on here is this right here. This right here, right? Because the market reversed at this point for some reason, okay? May that be liquidity, may that be the banks, may that be, you know, orders being canceled, put into place, whatever the case may be. This is a pattern that is brought up a lot of times. Now, who here knows how to use their fibs?
But I know a lot of people on our team need to get a run through on that.
Right. So the fib is essentially the Fibonacci tool, right? And the Fibonacci tool really is characterized by different levels, right? And it basically shows where the market is going to retrace back toward, right? So it's a retracing tool. However, how I use it is I use it as a midpoint finder. I simply use it as a take profit, a stop loss, and a midpoint finder. Now, what is a midpoint finder? Essentially, in the order block has an anatomy, okay? And I'll go back and show this to you guys. The order block has an anatomy, okay? And I'll open a new page for this. Okay. Now, the order block has this anatomy specifically. Specifically, what it does is essentially we have the candle that goes down, which is characterized as a red candle. Okay. And then we have the candle that goes up and immediately reverses. Okay. Now, essentially, the candle that we want to focus on is this candle right here. We want to focus on the red candle, the candle right before the move upward, right? This is known as the impulse. We want to see the candle right before it. So this right here is the order block, or OB, right? And there are two parts that we want to essentially, there are three parts that we want to take into consideration. First off is the open. The open is one entry, right? So that's usually where you can enter. That's an entry. Okay. Make sure that if you guys have background noise, to please mute yourselves. So that now we have this entry up top here at the open. Now we also have the 50% of the order block candle.
Yes.
The 50% of the order block is something known as OTE, or optimal trade entry. Okay. Now the optimal trade entry is a term that was coined to essentially place a very, very low drawdown entry so that you can maximize your risk to your reward, right? So, and then back here at the wick, some people, you know, depending on who you ask, will put their stop loss under the wick or at the candle close. Personally, I put it under the wick, just to have a little bit more leeway, right? I don't put it at the candle close because sometimes it just wicks the candle close and then goes back up, right? So does everybody understand this anatomy? So the order block is characterized by the downward candle before the move up. And if we reverse this, it would be the upward candle before the move down. Okay, same thing. Now this works because the market favors extremes. The market favors extremes. It loves extremes. Why? Because at extremes, people's stop losses get hit. At extremes, people think that trends reverse. At extremes, people get confused. Minority traders get confused, and that meaning, you know, the minority of traders get confused, right? Meaning all of our retail, all of our hedge funds, all of our, you know, other people that don't exactly know how to institutionally trade, those traders, which remember, we are very numerous, but we hold low volume, right? But they still want that volume. So they're going to fake us out with trying to go through extremes. Because if, say, it wicks all the way down here, you're going to say, oh, it just broke my support. It's going to sell now. And a lot of people may start selling. And, you know, don't get me wrong, but I have seen a lot of signals where it hits this point and they start selling. And they get a sniper entry to the wrong side, right? So does everybody understand this anatomy?
Yeah.
Yeah.
Yes.
I have one
Yeah?
question. So you're drawing the fib on this institutional candle before the impulse.
Yes. Well, no. So I'll go back and show you what I mean by this, okay?
Okay.
So let me go back to my chart in GU, right? Now here, what do we see right here?
An engulfing candle.
Some may know it as an engulfing candle.
Yeah.
I know it as an order block. Okay, so I'm focused on which candle? Which one of these two candles am I focused on?
Bearish candle.
The bearish candle, right? The blue candle. I'm focused on this candle right here. Now, what two parts am I concerned about?
Open.
The open? The open and my optimal trade entry, right?
Oh, yeah, 50%.
The 50%. Now, how do I find the 50%? Do I just eyeball it? No, I can pull out my fib and I can find my 50%.
Yo, I'm not going to lie, James. Sometimes I eyeball it. Like,
oh, yeah, I eyeball it too. But this is just to be proper, right? This is just to teach people how to properly do it, right? So there you go. You have your answer, right? Now, how you use the fibs properly is you go from swing high to swing low, or from swing low to swing high. So you load up your fib, right? So you load up your fib. It's Alt F on TradingView, and you go from this bottom wick, which is your swing low, to your swing high. Why? Because price is retracing now, and you're going to get a level that essentially pushes the market back up. Okay? So you start right here, you drag it all the way up to your swing high, and there you have your fib, right? There you have your fib. Now you may notice that my fib is a little bit different from other people's. That's because I have special levels, right? I also have all of these extensions which act as my swing take profits, right? Which I will show to you guys later. Now, We have this fib as an additional confluence, but I don't particularly use it religiously, right? We have the 886 and the 0.79, right, which is our kill zone. This is our kill zone, right? So now we can get rid of this, and then just keep in mind all of our take profits. I'm just gonna get rid of it just for simplicity's sake. Okay, so you guys can focus on the order block, which is the lesson, the order block, right? So this line right here basically shows the 50%, which is our optimal trade entry. This is where we enter, right? So now let's go ahead and mark this at our 50%, and you can mark a limit here. Okay, and we put our stop loss right here at the end of the candle, which ends up being a 26 pip stop loss. A 26 pip stop loss. And now our take profit using our fib, right, would be the 0. That would be take profit 1, which ends up being all the way up here. Why? We have all of this liquidity up here to fill. We have all of this liquidity up here to grab, right? Why? You guys remember that I told you that a lot of these candles on highs, if they're wicky like this, that means that there's obvious liquidity up there for people to grab. Now, in this situation, if we would have returned to the 50% of the order block, what would have happened? Our limit order would have gotten wicked. We would have gone into 3 pips of drawdown, and then we would have fired off for our 174 pip TP. Now here, if we see how much we're up right now, we're up almost 40 pips. When a lot of other retail traders are just starting to think about buying, we are already in from a wick entry. People are going to think you're magic. People are going to think you're insane. But at the end of the day, it's not that you're insane, it's that you know how the market moves. It's that you've studied it, right? Now, in this situation, we go back up, right? Fill this liquidity, and let's see what happens. We get another entry.
Going long.
Now, here's a big point. A lot of people said, "Hey, this fills all the confluences to go long." You would have been right here, right? You would have been about 25 pips in profit, and then your stop loss would have gotten hit. Oh, well, no, it probably would have missed it right here, but you would have been in heavy drawdown, right? And I know that some people have a chronic over leveraging problem. And that's not to at you. That's just how a lot of new traders are. I was there as well, right? It happens. But self-discipline is going to save you a lot, especially in this business, right? So let's continue. Let's keep watching.
Don't look like it's doing too much to me.
It's going long.
Oh, okay.
Yeah, you just gotta be patient.
Yeah, that's my problem.
All good.
These are 2-hour candles, though.
Yeah, these are 2 hours.
Yeah, definitely. You gotta be really patient.
At the end of the zone there, I didn't know he was going to extend them out.
Now our take profit just got hit.
See,
okay.
Yep.
Take profit 1 just got hit. Take profit 2 just got hit. Okay, let's count our total pips. 224 pips. Over the span of our original entry was the 7th of August, and this was the 18th. Took about a week, right? Now this right here could have been a re-entry on the 12th, and again, we could have held this position. Now this position here, you are going to see this at some point, and you're going to think about something called a Wyckoff schematic. This is something known as accumulation. Now, this is to all of my empire people. A lot of my empire people know what this is. Take this as an example. Zay, I'm pretty sure you're in here. This is accumulation, okay? That's just a side note to my empire people. Now back to Giselle's group. This right here was known as a simple concept of order blocks, right? This simple concept of order blocks makes you stay in this position for a swing position, but with a very, very, very small risk. Now, yes, you could have taken profit once you saw it coming back down. I wouldn't have. I would have held it, right? I would have held it. Because a lot of people don't like swing trading, but personally, me having a little bit larger of an account, right, at 25K, what am I going to do? 25K on a 1.0, right? This would have gone, what? This went 106. That would have been $1,000, right, on my 1.0. Now, all of this would have gone $2,290 on a 2.0, on a 1.0, right? Which is kind of worth it. It's kind of worth holding 1 week. It was 1 week, right, for 220 pips. And in the background, you're also running a lot more other trades, right? Because there's something called correlation in this market, right? And that correlation also helps you say, if GU is buying, that means UJ is selling. That means EU is buying. That means GCHF is buying. That means GCAD is also buying. That means a lot of the GBPs are also buying. That means that Euro GBP is selling. A lot of people may not realize this, but once you get one analysis right, you have the potential of hitting 1,000 pips in one night, which has been done. And I'm pretty sure Deontay was there, I think like 2-3 weeks ago, where me and Peppa were literally just hitting like 4 different pairs all at the same time, all like 200 pips in profit. Because we know the correlation of the market, and the more you study, you will correlate the pairs yourself. And I'll give you a little quick list of the correlations. But before I do that, I'm going to finish off this lesson, okay? So let's continue looking at this. Our take profit got hit, more liquidity was created, our retrace comes up.
Seeing up the order block. Boom. Okay.
Dang, that's a huge drop.
This is a huge drop, right? Why do you guys think this huge drop actually happened?
Exhaustion.
Exhaustion. Some people call it bearish pressure, bullish exhaustion. Some people may call it
Consolidation.
What I call this is price inefficiency. And a lot of people may not know this, but this right here is inefficient pricing for the banks. You can't stack entries here for the banks. They won't. It's not safe for them to. Essentially, what they are doing is they're moving price so much in their direction that they can't stack more entries, and they need to stack more entries so that they can make most money, right? This right here is something known as an inefficiency, and I will save that lesson for another time so that you guys aren't overloaded and you guys can just practice order blocks, right? This next couple weeks.
How you just gonna take all the cover?
Huh?
Oh shit.
What?
Please mute your microphones, y'all.
I don't think that was meant for you, James.
Okay, that's fine. Well, essentially, right, we have this, and a lot of people here, what would you do if you were in this situation? And I was in your circle. I know exactly what you're going to say.
Oh, yeah, let me take a buy right now.
What would you do? What would you do in this situation? Are you going to buy or are you going to sell?
I'm putting a 0.99.
Honestly, I'm not taking the trade, but if I'm a retail trader, I'm probably going to look to buy.
What are you going to look to buy? Is this not a double top?
Two, ain't it?
I know that a lot of people in your chats are going to say, this is a massive double top. This is going to be big pips. Is it? Isn't it a double top?
Yeah. No, sure.
I mean, technically it is. Why wouldn't you take the double
It
top?
didn't reach the point. I mean, the second one, it didn't reach the point. The top.
Okay. Now, let me tell you why You'd buy for fair value gap. Yeah, there you go. Perfect. But a lot of you guys don't know what that is. That's a more advanced concept, right? But he's completely right. You'd buy for the fair value gap. This right here is a fair value gap, but I will explain that much later. This is a buy. This is not a sell. A lot of retail traders are going to paint this and they're going to say this here is a sell because double top. That's what they're going to say. This is a sell because double top. That's all they're going to say. This is a sell because double top. The banks know this. The banks know what courses are leaked, and they're going to paint this on purpose. Now, this is what a lot of retail traders are going to do, because I've seen this and because I was one once. You're going to put their stop loss and be like, oh, well, maybe, you know, like a 53 pip stop. Yeah. That'll be fine. That'll be fine. These are big pips, big stop losses, right? Absolutely not. So they're gonna put like a massive take profit to take their people and say, oh yeah, this is gonna be like massive pips, right? Well, I don't think so. The banks
Fill the gap.
prefer extremes. The banks prefer extremes. It preferred an extreme right here. It preferred an extreme right here. It just triggered sell stops. What is it gonna do?
Buy like a motherfucker.
It just triggered sell stops, right?
It's gonna fill the void.
Now let's see what happens. Oh well, hit their stops and now it's falling. Took liquidity again. Took liquidity again. You see, it's all a game of just catching liquidity.
Yeah,
It's a game
filling
of
the
toss
void.
liquidity here, toss liquidity there, toss liquidity here, toss liquidity there. All that it did was trigger the sell stops, give people hope, and then shoot back up. And again, here we have another example of volume divergence. That's what it's called, right? Volume divergence, meaning a volume spike on a candle. We have untouched liquidity. Where's it going to go? Up to fill this, right? Up to fill this. What happens? Drops a little bit, boom, shoots back up. This would have been an order block as well. 50% optimal trade entry right here. Your order would have looked something like this. Optimal trade entry right there. Stops beneath the wick. That's a 12 pip stop loss for a take profit all the way up here. And that would have hit. Now, of course, I'm saying this in hindsight, but what a lot of people don't realize is that when you start seeing order blocks and when you start observing them, you will end up seeing how easily you will catch them. Okay? Look at this. What is this? What is that candle? Volume divergence, right?
Yes.
So what is this? Untouched what? You even have it written up here. Untouched liquidity, triggered stops, right? So where's it going to go now?
Oh,
You have untouched liquidity. Where's it going to go? Fill it, right?
Fill that up. Yes, sir.
And you have your liquidity filled. Now you still have your swing position down here. You still have the swing position up here.
So realistically speaking, when it comes to live trading in the field, you have mental fortitude to hold a trade that long when you see the huge variances in profit.
It all comes down to mindset.
Yeah.
It all comes down to your mindset. I have multiple confluences for this trade back here. I see this order block. To me, this is also Wyckoff accumulation, right? A lot of you guys may not know what that is, but I'm saying, you know, I'm speaking out of my own mind, right? Buying climax, selling climax, spring. Yeah, selling climax, spring, coming back up, a test, right? So, and then we had the sign of strength, test again, right? And then we shot back up. To me, this was Wyckoff accumulation in the cleanest way. And this was also a touch of an order block, which would have given me a swing position, right? So, whoa, what the hell? Why do I have that on the side? Oh, well. Our final take profit would be all the way up here. Will it hit? I don't know, but I already have a lot of different. I have a lot of profit already netted. Look at this. At this point, we have 356 pips netted. 356 pips from our original entry to where? Literally like 15 days, and we're catching that. Now let's continue on. Oh, and that's actually where it ends. That's where we are right now. So if you would have held this swing position from down here to all the way up here, you'd be almost at 400 pips in profit. Almost at 400 pips in profit. Now, a lot of people try to go quickly for pips, but what you don't realize is that this is only one example of an order block. In here, there are many other examples of order blocks. You could have caught this sell off an order block. You would have caught this buy off a low, right? You would have caught a lot of other positions off of an order block. Does everybody understand what it is now?
Yes, sir.
Do you guys understand it?
So would this apply to like a smaller time frame candlestick chart?
Yeah, you can apply this to a lower time frame.
Yeah, I like to trade with the 5-minute order blocks.
Now, here's the thing. This is not a scalping strategy. This is not a scalping strategy. It's all about your risk to reward. So you can have a 3-pip stop loss and a 40-pip take profit. Now, imagine those little accounts, what you could do with a 3-pip stop loss. You could pop a 0.10. I saw somebody else in the chat earlier popping a 0.10 on a very, very small account.
That's me. I literally popped a 0.10 on gold just now.
Yeah, you see a 0.10 on gold. What if you only had a 3-pip stop loss and hit your take profit at a super high lot? You're still properly leveraged.
Yeah, you're good.
You're fine.
Risk to
But
reward.
the thing is, again, risk to reward, not pips. Risk to reward. If you're going into a trade thinking how much you're going to earn, how much you're going to win, you're going to lose that trade. Or you're going to get lucky. And one of the things, this may sound kind of bad, but I hate it when new traders win. And it sounds horrible, but let me explain to you why. Because a lot of times they end up correlating in their mind what they did to succeed the first time, and they say, I'm going to do it again.
Happened to me.
What they don't know is that they got lucky, right? And they end up over leveraging or popping an even higher lot. And they end up losing their profit and some more, maybe their whole account. Now, I'll tell you guys a quick story before I leave. Oh, actually, before I go on to the next part. If you guys are interested in stocks, I'll go over what made me take Tesla, Zoom, and Apple. But essentially, what I said is when I first joined trading, when I first started to learn how to trade, I had an $150 account, and one of our guys sent a gold signal, and I popped a 0.25 on it. Did I know what proper leverage was? No. Did I know that I was going to blow my account in 10 seconds if it did not go immediately into profit? I didn't. I didn't know. I ended up making 7.5K that night. I didn't withdraw. I felt like the king of the world. I was trying to advertise to everybody, hey, join my team, join my team. The very next day, the same guy sent another gold signal. And that one went about 15 pips into drawdown. But by the 13th pip, my account was done.
You blew 7.5K.
Yeah.
Yo, you dropped a huge lot or multiple positions.
I was dropping 1.0s 4 times.
Yeah. That'll do it for you.
Yeah, I got somebody on my team like that too. I was begging him to call it a day when he made his first 1,000 in a day. And, you know, he listened to me the first day, but then he's like, all right, tomorrow I'm about to make thousands again. And it didn't work out.
And he blew it.
He blew it. Then he hit the books and he's been studying and now he's back at his profitable shit. But it's a shame that he had to experience that first.
It's a shame that a lot of traders have to experience that. Now do you understand why I say why I hate it when new traders win without understanding why?
Yeah.
Right? Because if they win and they get lucky, they're going to blow their account.
I've been there.
Because and then they're going to say, "Oh, I love this pair," when they don't even know the first thing about that pair. They've
No
never
cap.
researched it. They've never understood the fundamental behind it. They've never said, "Hey, is this a more volatile? Does this move during Asia? Does this move during Tokyo, during New York, during London? What are its patterns? What are its tendencies?" A lot of people don't study these pairs.
Mm-hmm.
And that is the biggest downfall for you as a trader. You have to think like a bank, and you have to trade against your old self. Now, why?
No, you got to think about the algo.
This is something that helped me, because that algorithm is going to be way smarter than all of us. Now, the only thing that we can do is try to abuse it, right? Because one thing that a lot of people who studied and traded for years before us, they came up with things that now we use, and the market still uses them, like accumulation, like order blocks, like fair value gaps, right? Like PD arrays, right? A lot of people don't know what those things are.
Yeah.
Like, a lot of people don't know how to use the 10-minute or the second time frame. Some of the best traders in the world use the second time frame.
That's insane.
Now, what do they use it? Well, because they want a 1 pip stop loss. They're dealing with $100,000 and they're popping 50 lots with a 1 pip stop loss, and they're getting into profit. How many of you guys have heard of 1 to 64 risk to reward? 1 to 70 risk to reward, 1 to 200 risk to reward.
Yeah, that's insane.
That's insane, but it's possible.
Yeah, I know.
We've done it before,
For sure.
right? Now, let me show you guys a big example on AUD and ZD. Actually, do you guys want me to show you guys another example of this? Or actually, no, that actually has to do with Wyckoff, not with I don't think it has to do with an order block.
Do you have a video on Wyckoff accumulation on your YouTube channel?
Yes, I do.
All right, cool.
Yeah. I have it on accumulation and distribution. So to not make the story very long, this is Wyckoff distribution, right? Now, let me go down to the 10-minute time frame. Let me go back down here, back up here. Essentially, I saw this and I said, this is definitely distribution. Distribution is essentially the brother of accumulation, and it's going the opposite way, right? We see the upthrust after distribution, the last point of supply, and I'm not going to bore you with the details because you can go watch that video. We have the last point of supply, right? And you don't have to understand what it is. You just have to know that it exists, okay? Now, we have this right here. Let's delete this. What do you think this purple box shows?
Liquidity.
Okay.
Yep, my bad.
Liquidity. What about what I just showed you guys?
Order block entries.
Right. This is the last bullish candle before the move down, right?
Oh, yeah.
This is the last bullish candle before the move down. So what happens? We can place our limit at what? At the 50%, right?
Correct.
What is the 50% in this situation? Right around here. Perfect. Now we can delete this and we can put our fit back. Right? Now, this is the 50%. What is our stop loss? The top, right? What is the top? Right here. The top of the line. Whoops. The top of the line right here. Which ends up being the close of the candle, right? The close of the candle is our stop loss. Now, what ends up happening? We end up having a actually, let me move this back up to optimal trade. 3.8 pip stop loss off of a limit.
Yeah, that's nice.
Which it hits, wicks, and falls. This order block right here netted you, and you have your last take profit at the 2, netted you at least 70 pips. Which, if we do a couple quick maths, it's let's see, 70 divided by 3. That's a 23-to-1 risk to reward ratio. A 23-to-1 risk-reward ratio. Now tell me, when have you seen that
No.
before?
Grand Theft Auto.
Shoot, I do it.
When have you seen a 23-to-1 risk-reward ratio? Very rarely. Very few traders know how to do it. But now I'm
Yeah.
teaching you guys how to do it, right? Essentially, you take the 50%, you set your limit there. You're going to get to the point where you want to set your limit a little bit high, like a little bit before the 50%, because you're so accurate that your spread literally doesn't activate your limits.
Yeah, that's what I always tell people too. Set your limits a little off from your target area because it'll hit it and then you'll be like, oh snap, it just beat me out of all the money I could have made.
It literally misses by spread. You remember, Deontay, that like GBP CHF trade last week where it missed my limit by literally not even half a pip?
Yeah, makes no sense. Ridiculous.
Like the spread was like 8 and it like moved like right into the limit and didn't activate and it shot up.
Yeah.
And it went for 120 pips. Same thing happened with GA the other day. Well, like 2 weeks ago. Garrison, his limit missed by 2 pips and then shot up to hit his 184 pip TP in 2 days. This stuff is real. You don't have to be trading off of harmonics. You don't have to be trading off of other stuff like that. Now, if you want to, go ahead. But this is what smart money is. Now, this is just, you're just scratching the surface of smart money. Smart money is watching liquidity. It's playing ping pong with the sharks and the whales. Now, what are the sharks and the whales? Sharks and the whales is a completely different concept. But the bulls and the bears, let's put it like that. You're playing ping pong with the bulls and the bears. And you're trying to catch liquidity. Boing, pass over here, catches liquidity. Market favors extremes, right? If the market favors extremes, where's it going to go to? Right up here. Oh, coincidentally, this is an order block. Which would have done you what? Optimal trade entry. A little bit further away from your from the 50 because you're probably going to miss by spread. Your stop loss becomes 3 pips. And your take profit becomes equal lows right here. That's your take profit 1, 37, right? Or you could even continue it on by putting your fib like this and like that. What ends up happening? Your take profit is all the way down here. Is it all the way down there or is it lower? I think it's lower. Yep, it's lower. And your final swing TP on the extensions gets hit.
Sheesh. Oh my gosh.
For this order block with the 3 pip stop loss, 74 pip TP. Another 1 to 23 risk reward ratio. You caught it twice. 1, 2. 2 times. So you just caught 74 plus 70. What is that? You just caught 144 pips in one, and what is it? One night, 25th of August. And yeah, in one night, you caught 144 pips with a total risk of about 7 pips. Now, does this seem insane to anybody?
It does not.
I love the concept. I love trading that way. So
Trading
James,
this
how can
way is
price-
going to help you grow accounts. Because I know that a lot of you guys may have trouble growing your accounts. A lot of times people end up sending trades with 35, 40 pip stop losses, and you end up popping a 0.05 on an $100 account. You should only be popping a 0.01 on an $100 account, no matter what. You should not be trading US 30 or gold
I'm dead.
on $100 accounts. And
Hey, somebody needed to hear that.
it sounds like it sounds maybe a little bit silly to say it out loud, because but a lot of new people don't know that. A lot of new people think they can, and
Yeah.
sometimes mentors, it's such a simple concept to you, but you have to keep in mind that you're mentoring somebody else, and they know nothing.
Mm-hmm.
Keep that in mind when you're teaching your downline or when you're teaching your friends. Okay? Keep that in mind. Pretend that they know nothing and go over the concept again and again and again and again with them until they understand it. Okay? That's what a good mentor does. Now, let's look at this a little bit, a little bit further. This right here is trading foreign exchange at its finest. Is the market going to give you these perfect setups every single day? Surprisingly, yeah, it does. Surprisingly, if you look back on every single pair and you back test it, you will notice that almost every single night between the times of 8 p.m. Eastern to 10 p.m. Eastern, that is the Asia kill zone. Okay? And between London from 3:30 to around 6 a.m., that's London kill zone. Okay?
Mm-hmm.
From 8:30, from 7 a.m. Eastern to 11 a.m. Eastern is the New York kill zone. New York kill zone is all you need to trade to be a professional trader. That's what I do.
Me too. Oh, God.
That's all you need. But a lot of people want to be over trading. And here's the danger of over trading. If you put in way too many trades at once, or you're trying to force a trade, you're not going to get much quality. You're just going to get quantity. Your stop losses aren't going to be as tight, because analyzing a pair shouldn't take 5 seconds. Analyzing a pair should take a couple minutes, 10, 15 minutes, right? And if you're just zooming past every chart, you're not going to understand why these things happen, and you're going to miss a lot of things. Now, again, to you guys that are trying to build your accounts, leverage properly, please. There's no reason why you should be over leveraging. I was there, and now 3 years later, I'm a professional trader, and I don't over leverage unless I have a 3-pip stop loss, which then I'm not over leveraged, right? But at the same time, a lot of you haven't gotten up to that point yet, and that's completely fine. It's a journey. But don't over leverage, please. Okay? I beg all of you not to do it. If you have a small account, $100 to $200, stay away from US 30. You may see a lot of people, having a lot of copy paste profits and saying, "Oh, I just made bank off of US 30." Just because you see somebody else do it, does that mean you will do it your first try? It's a dream.
Mm-hmm.
Okay? It's a dream to think that you will have the same results as anybody else. You are the creator of your own results. You are the one that's going to draw up your own stars when it comes to this. Because how much time you practice, finding the correct resources, finding the correct mentor, finding the correct everything is up to you and only you. Doesn't matter what platform you're a part of. How much effort you put in, is up to you. It's not up to your mentor. Okay, it's up to you. So I just taught you a concept that people pay thousands of dollars for in an hour. Now it's up to you to go out into the market, back test it, and see how many times it gets respect, how many times it works, how many times it does it, what confluences you may need to have.
Paper trade it.
Huh?
Tell people to paper trade it or demo trade it.
Right, paper trade it. Trade it. Literally paper trade it. That you a lot of people have this overwhelming shame of saying, "Oh, this was demo." Dude, it's your money. It's not the other person's money. And if they try to judge you for practicing on demo, honestly, screw them. They don't need to know you. They don't need to bag watch you. Okay? Because they're not the one putting in effort. They're not the one opening their demo, going up to their trading view and saying, "Okay, I'm going to spend the next 2 hours looking and backtesting." And you do that. And you find another confluence. Say in your mind, you're saying, "Well, these candles just jumped down all the way down here for like 80 pips. And then it went all the way back up and it covered those candles." You have just discovered the fair value gap without anybody teaching you. And now when your mentor, or you see it on Go Live, or I don't know if you guys teach it on Go Live, but like let's say you guys, reach out and you guys reach out to me or to Deontay or whoever, and you say, "Hey, I found this." Then I'm going to go sit you down and I'm going to say, "Hey, let's have a one-on-one. You have just discovered the fair value gap. This is how you trade it. This is how you properly use it. This is when you use it. Okay. And you have put in so much effort that you have may just discovered and gone past the other person who was telling you, oh, why are you using demo? Because they're too focused trying to copy paste and not be their own signal, that one day when, you know, whatever platform you're on doesn't exist anymore, they won't know what to do with themselves. But you have just become a professional trader through whatever platform you're from. Doesn't matter, because you put in the effort. Okay. Now, for everybody that came in for the order blocks, what's a solid broker? Personally, I use Eagle FX. Reason why I use Eagle FX is because they're regulated by an offshore entity. Some people say, oh, well, you know, like whatever. But I think they aren't owned by the same bank as Hugo and KOT. They have never manipulated the markets, and their liquidity broker is actually owned by a big bank. I think it's owned by Wells Fargo. So personally, I trust them. They're very good. And I'll send you guys, oh my goodness. I'll send you guys the link later on. Now, apart from that, what else can we say? My YouTube name, yeah, I'll send you guys my link tree. Hold on. Let me stop sharing for a second. Here we go. There you go. That should be all that you need. I'm pretty sure that's all that you need. The recommended broker link is going to show up as the recommended broker link. So where is it? Chat. Here we go. Chat. How to spot an OB once more. Okay, yes, I will go back to that in 1 second. This right here, click this link, the preferred broker, and you will be able to sign up over them. There isn't any lengthy sign up process. It's literally just type in your name, your email, double verification, and you're good to go. And this is our channel. This is our academy. Well, the academy is literally just for questions to be answered, and we also have a textbook to help you guys, all for free. And our YouTube is right here where you can watch all of our previous classes, recorded and uploaded. Now that we've done that, let's go back to the order blocks. So essentially what you want to see, Andrew, is you want to check, first you want to check a confluence, right? Right now we're in a downtrend. We're going down, right? Correct? We're going down. So you're only going to be looking for bearish order blocks, right? We're only going to be looking for bearish order blocks until bearish structure is broken. In this situation right here, if we zoom in, right, it is the last candle, the last opposite candle before the impulse move in the direction that you're going. Let me give an example. The last opposite candle, if we're in a downtrend, you're looking for a bullish candle. If you're in an uptrend, you're looking for a bearish candle, right? So this right here is our last bullish candle before the move down, right? Now this right here becomes your order block. Let me zoom into it. This right here becomes your order block. Now if we have this rectangle, this is our POI, the point of interest, right? POI.
So how do you know it's the last one without the hindsight?
Well, because this right here would have dropped. It returns to it. Your entry's right here, not back here. Your entry's right here.
You're setting a limit at that price after you watch it happen, and then it's gonna come back and wick at that price. Is what
let me replay. So say we go back here, right? At this point, you'd be, let's see, let's play it a little bit higher. So let's have our bullish structure return. Now bullish structure returns and it comes back up here. So at this point, we see that the market's coming back up, right? The market's coming back up. So at this point, we would set a limit, a sell limit at the 50%, a little bit before the 50% of this previous candle, which in this case would be, oh, whoops, do it from the body, right? It should be the body. So it should be right here, right there, right? And you want to put it a little bit in front of the 50, okay? Which right there, you probably would have missed by spread, which is literally like a pip. You would have missed by a pip because you're that accurate, okay? And you put your stop loss either at the wick, behind the wick, or behind the body. At this point, you could have had, if you had the body, you would have had a 1.2 pip stop loss. For me, I like to risk it a little bit more, and I like to put it behind the candle, behind the end of the candle. And you would have gotten away with that. All right? Does that make sense? You set a limit afterward, not before. So you're not using hindsight here. You're using foresight. You know that the market will return to this point to continue downward. Does that make sense?
Yeah, I got you.
Are you sure?
Yeah.
If anybody has any questions, I'd rather you stop me now and ask me than end up losing money in the market because you didn't fully understand the concept. Okay, I have time. Anybody have any questions?
Run that back for me one more time.
Okay. So say you've returned to this point right here, right? Say you've returned to, where are we? Right back here. Say you've returned to right here, right? And you're just trading regularly in the market. Okay, cool. Now you are going to watch this happen. You're going to watch it drop. Cool. Now, in your thought process, you're going to be thinking, hey, the market's going to continue on downward, but it hasn't cleared these lows, right? Since it hasn't cleared these lows, you know that it will probably return back to a previous point of interest. Now, the market likes extremes, which means that up here, this pivot point is going to be your point of interest. So at this point, you're using foresight, and you're saying, hey, right here is my order block. Now, your order block, again, is what? Your order block is the last candle moving in the opposite direction from your impulse. Your impulse is towards the bottom, bearish impulse, right? The last candle before the bearish impulse, which ends up being right here. This ends up being your order block, okay? Now, from here, you have 2 points. You could either enter at the open of the candle or at the 50% marked by the yellow line. Whichever one would have been fine. You're risking a little bit more on the open, 4 pips, but you're risking a little bit less on the close, which would have been 2.9 pips. Okay. And now your stop loss, right? The last part of the anatomy of the order block is the stop loss, which you can put a little bit behind the end of the wick, or you can put it at the close of the body, which would have been right there. Either one would have worked. But for me, I like putting it behind the candle just to be safe, right? That's a little bit higher. Cool. Now, in this situation, you're using foresight, like I said, because you're putting your limit, you're putting your sell limit right here, right at this price, your stop loss right there, and you can go to sleep without having a care in the world because you know that your limit's going to hit and it's going to hit your take profit. Now let's see it happen. Limit got hit. And there you go. Your limit got hit. And at this point in time, you're running at 24 pips in profit within a couple minutes. Within literally like 2 hours.
So where do you put your take profit?
I usually put the take profit off of my extensions. So you remember the fib extensions that I showed you?
Mm-hmm.
So like from right here, right, the fib coming from here all the way down here. My final take profit is at the 2, which is all the way down here.
Okay, I got you.
Yeah, and then that take profit would have gotten wicked and then continued on upward. So let's keep looking at it. Now all of this is running off a 3.2 pip stop. Here comes your second entry, which was back tested later.
Do you ever remove your stop losses to try to get into a risk-free trade?
Yeah, I do. I just move my stop loss into entry. I just move my stop loss to entry, or I close partials. Do you guys know how to close partials?
Yeah. You pop a bigger lot size. You close a certain amount of lots.
Right. So at this point, you already hit your take profit, which is 71 pips within a day. Within 24 hours, you just hit your take profit with a 3.2 pip stop. Now, according to your accounts, what lot size would you have placed?
0.10.
0.01.
0.01?
Not bad.
Okay, 0.01. I would have popped a 0.20.
I'm jacking pop 0.10. Yeah.
0.10?
Yeah.
Not bad. That would have been $70, and you would have lost $3. You would have lost $3.20 for $70.05. Who doesn't like
I
that?
would have.
That's a great.
I would have lost
trade.
32 cents for $7.
You would have lost 32 cents for $7. Yeah.
Yeah.
For me, on my pretty large 25K account, I would have popped a 5.0.
See, after
I
that
would have
Tesla.
said, hey man, like I'm risking 3 pips. That's gonna be what? Not even $100. So yeah, that'd be like $100. And then I'd gain what, 7,000?
Yeah, definitely
something
worth taking that trade.
So
Definitely worth taking that trade.
Go on the Zoom call. I have someone trying to hop in right now.
Go ahead.
it's
It's gonna be recorded.
Account gain.
It's recorded. So if they've missed a lot of the Zoom call, but if they want to go back and watch the other parts, they can.
Right. Okay. There's not a password on it?
No password, bro. No password.
Okay, cool.
Hey, so when you give these Zoom calls, do you record them and just post them to your YouTube?
Yeah.
All right, sweet.
Yeah. And I'll send you guys the link. I'll send Giselle the link. And so now that you guys see this, now it's up to you guys. Do you guys want to check how I got Tesla, Apple? And
Yeah, James, because that was ridiculous. I'm looking at that trade right now, and I'm just like, wow.
Pretty crazy, right?
Yeah.
Pretty nice. Now, does IML have a stock division?
I wouldn't know, actually. I don't think.
Since we have HFX Academy, HFX people focus on stocks, indices, and currency pairs. But when it comes to what most people trade, which is the basic Forex Academy, which comes with the basic package, not too many people look into trading the stocks. But the people that do, they don't really share too much.
Okay. Well, I mean, I'll help you guys out. That's not an issue because I started in stocks, so I can help you guys out.
Same.
So let's go ahead and let's look at which one do you want to look at first? Zoom, Tesla, or Apple?
Zoom.
Tesla.
For show.
Zoom.
Damn.
Okay. Zoom is one of my best trades to this day. It went up 28%.
Nice.
And its current market, its aftermarket price, which comes, like after the market closes, is I believe at 400. What is it at market close, market open? What is it at aftermarket?
Go back.
Oh, it was 400 aftermarket. My fault.
Oh.
So it's at 400 aftermarket. Now, now look at this. When you look at a stock, you should be looking at a couple things. First off, you're looking at what sector it's in. If you don't look at what sector it's in and you don't look at any research, you're going to fail, right? So research is key in everything. So you're looking at Zoom and you're saying, okay, I know that this is a relatively new tech company. It doesn't have more than 10 years. Okay. So this is a relatively new tech company. Now here's a defining factor about tech. Tech, a lot of times, is very reactive to news and very reactive to earnings reports. Now, I knew that Zoom had an earning report today after market close. However, when I went back, right, and I just looked that up on Yahoo Finance, and I just saw, okay, after market close, earnings report. Let's look at that. Stock earnings calendar. You guys can do this yourself on Yahoo Finance. It doesn't really matter. Yahoo Finance, and I saw that today, or yesterday, my fault. Well, actually, yeah, today, my fault. Is I saw that Zoom had it. Where did Zoom go? Where did Zoom go? Where did Zoom go? It was right here. Huh. Well, on the stock price, it said right here, right? Zoom today, upcoming earnings, right? The upcoming earnings was after hours. It was on here. I don't know where it went, but it was after hours, and that after hours position was something that I was like, okay, cool. I know that it's going to spike up, or
ISO came. Oh,
what?
as soon as I say something, then
Um,
I'm about to mess up the vibe.
let me see something. Okay, so right here, I discussed this earlier. Wyckoff accumulation. Here it's something called reaccumulation for all my people in Empire. Reaccumulation, again, for you guys that don't know, is in an uptrend or after, like without there being any distribution, this accumulation happens. Basically, it happens again, right? Accumulation happens again. So here we have our buying climax, right? The pause in bullish structure. We have our selling climax. We have our automatic rally, our secondary test in phase B, another secondary test in phase B, a spring, a test, a bust up or jumping the creek, right? A test again, and then that would have been our entry. However, since I wasn't too confident in this, I looked into news and I said, okay, when's our earnings? Earnings happens Monday. So I waited until the next day. And what I ended up doing is I ended up saying, okay, well, I want to see a little bit of impulse what happens on Monday morning, right? Because I wasn't really even focused on Zoom at that point. So I went to my 20-minute chart and I ended up saying, okay, market opened right here. Since the market opened right here, I said, okay, let's watch how it reacts off of the 20-minute chart. I saw a drop and I said, okay, expected, pretty cool. That's fine. Not an issue. But essentially what I said was, hey, how am I going to make sure that this position is going to go bullish before I actually, do anything stupid? Well, what I said is this gap right here, I shouldn't really worry too much about it because these 2 wicks have now just connected, right? So I'm just waiting for bullish pressure. This is our first sign of bullish pressure. And this stagger kind of just told me, why not? Put your stop loss below right here, right? And buy it. And I bought, and I bought at 308, I bought at 310, and I bought at 305. Those were my 3 entries, right? And it fired off. Now, do I have a particular take profit? No, I don't. Tomorrow I'll probably take profit from it because it is a news buy, right? But what happens is in this case, Zoom, right, decided, hey, my earnings are here. The aftermarket price, I knew that it was going to happen after the market, not before the market. That's why I didn't buy on Friday, right? I bought on Monday at around market open after this little bullish after this little candle dropped and retraced. I knew that there wasn't going to be much bearish pressure in this position. So what I did is I went ahead and bought, and I sent that out to my signals chat, and boom, right, it shot right back up. This is just a relative take profit. It's a little bit wider than that. My take profit's a lot wider than this. It's most probably going to hit, the 500. This may be even a swing position. I may even hold it all the way up to, wherever it may go. But I'm probably going to close out at least 2 positions tomorrow just to make sure that I net my profit, right? Now stocks are a little bit more advanced for a lot of you people, but That's fine. We're here to learn, right? And I want to teach you guys how to trade stocks professionally. And I did call this out so people can't call me a paper trader that I just TradingView traded it. But I actually did catch this position on TD Ameritrade, which is pretty cool.
Yeah, congrats on that one, James. Congrats, yo.
I should have hopped in.
Yeah, I sent it out, and I knew that a lot of people weren't going to get in because I didn't send an explanation. But some people did, and they are very happy because it went up 28%.
Nice.
It's crazy.
Now, for Tesla, who can tell me why I bought Tesla?
A stock split. Ooh.
Split for
5 to
sure.
1.
Stock split, 5-1. The thing is that most times after stock split depression happens. Who knows what that is?
I'm assuming because you said maybe it comes back down. Not sure.
Stock
It's
split
when the
depression.
whales sell.
Post stock split depression essentially is when a company splits a stock, and then they end up essentially it just splits and it keeps dropping. Because a lot of people don't realize that a stock split is actually positive for the company, because you buy a lot more stocks at a smaller point. A lot of jittery investors, they're gonna say, hey, yeah, my stocks may lose value, so I'm gonna go ahead and sell them. But they don't realize that their stocks is gonna stay the same value. They're just gonna be split into different entities, right? So say you had 100 shares of Tesla. Your shares, you're going to keep the amount of money that they're worth. You're just going to have more shares of Tesla.
It's basically like splitting a $20 bill.
Yeah,
The
essentially.
fives.
Right, essentially, yes. And then say that 5 appreciates, right? Into say that DXY gets stronger, and that $5 is worth way more. That's essentially how it works, right?
Nice.
So I said, okay, well, this probably won't have any stock depression. It won't have any stock split depression because of a very simple reason. This is a hype stock. How many people and their mother have you seen buy Tesla?
Everyone.
Everybody.
Everybody's buying
Buddy
Tesla.
and his mother buy it in like January.
Yeah, everybody buys Tesla. Now, I bought Tesla before the stock split at around 556, and I held it till around 890. A lot of people started buying it during that position, and you would not believe how many people I saw claiming to be professional stock traders say, oh, buy Tesla, buy Tesla, buy Tesla at 900.
Wow.
And I'm just kind of sitting there like, they don't know what they're doing. But at the same time, you have to end up realizing, hey, this is a hype stock. People hear that this stock is going to get cheaper, and they're going to buy the hell out of it. Remember, stocks are moved by something different than Forex.
Belief.
Forex is moved by the algorithm and by liquidity, by money, by heavy money. Stocks are moved by investors and big equity. Meaning whoever has the most money, whoever buys the most shares, whoever can cap out as many shares as possible, they're going to be the ones that move the market essentially. Right?
Yeah.
Because the less of a stock that there is, the more it's appreciated. That's why Tesla split. If there are more stocks in circulation at a lower price, they are going to reach their market cap super quickly. Now you have to realize that market cap essentially is how many stocks a company is allowed to have at one time. Okay, so the market may have a 100,000 market cap or something like that, right? Then they split it, and now they have a 500,000 market cap. Essentially, they're adding more liquidity into the pool and sacrifice for a temporary fall. Because it was at like 2,300, right? And now it's at 429. They sacrificed a temporary fall for an increase in liquidity. Very simple concept. That's what made me buy Tesla. Everybody and their mother was buying it. And I knew that everybody, even if they aren't traders, they knew that Tesla was going to split. They knew that something was going to happen to Tesla. They knew that something was going to happen to Tesla. So everybody that's interested in the financial sector is going to buy it. because it's cheap now. And wasn't it just at 2.3K? It's going to come back there. The markets know that. Elon knows that. And that's why he ordered the 5-to-1 split. He wants more money, obviously. And do you not think he just bought another massive ton of stocks in his own company? Absolutely.
Of course he did.
Of course he did.
Elon's a genius.
And of course other people, well, he's not even a CEO at Tesla anymore. So of course he
Yeah.
can buy his own stock.
After that FTC violation.
But he can buy his own stock now. So he doesn't care.
Sheesh.
But you see how it's a lot different to trade stocks than it is Forex?
Yeah, I came from trading stocks for about 3 years before Forex. And some aspects it's way better. Some aspects it's way worse.
Yep, that's very true. A lot of times, unless you have news, the market barely moves. Unfortunately, there's a lot of suffering.
It's more of a long-term investment strategy.
Yeah, it's more of a catch it when there's when volatility is hot. Because if you miss those volatility pockets, there's going to be a lot of boring downtime. That's why I trade both. That's why I teach my team both. That's why I want to teach other people both. But because they're both very, very fun, but they're also both very, very challenging. So for example, let's go back to Apple. Let's go to Apple. Same thing. I knew that Apple was going to split, right? And when Apple was going to split, it didn't rise all that much, honestly. But I knew that Apple was going to split. And when I knew that Apple was going to split, I said, hey, well, if Apple's going to split, a lot of people know that Apple is a hype stock. Everybody, a signal that everybody falls back on is buy Apple. Everybody says that. Everybody says, oh, buy more Apple, buy Apple, buy Apple. Do they know why? No. They just know that it goes up, right? In this case, I saw accumulation. Selling climax, you have a very early spring, you have a test, you have another test, a secondary test, right? And then it's coming back up. You have the creek jump. And for me, right at this point, when I said, oh, stock split, this looks like accumulation, I took a chance and bought. So my position looked something like this. It should look something more like that. But yeah, actually, I would have probably put it right there. Yeah. So that was my position. Of course, the take profit would have been a lot higher, around the 140 mark. My take profit's around the 140, 145 mark. Now, why'd I do that? Again, I know the news, and I buy the news. I sell the hype. You guys remember Dogecoin a couple weeks back?
Oh yeah,
Yeah.
TikTok brought it back from the grave.
Yeah,
Yeah,
where's
I
it
know.
at right now?
In the garbage.
Back in the grave. It went back in the grave. Why? That was hype. I sold it.
What do you think of Bitcoin?
Bitcoin is perfectly okay. Bitcoin's amazing. Bitcoin's is a great thing. But I personally like buying XRP and Litecoin, Ethereum. Well, they're a lot cheaper. Chainlink, they're a lot cheaper, but they're also going to explode. I also mine Pi. I don't know if you guys know what that is. It's a free to mine cryptocurrency, which was developed by Stanford students, and I'll send you guys the link later, so you guys can read up on the article.
Yes.
It's very cool. And at 10 million miners, it's going to stop being mined, and then it's probably
Wait, how is it spelled? Is it spelled P-I?
Yeah, PI, like pi, like the little
Okay.
like the letter
Yeah,
pi.
okay.
Yeah, I'll send you guys the link later.
Hey,
But
so
for now,
would you recommend Coinbase for like coins and
Fuck
stuff?
no.
they hold your money. Coinbase holds your
What's-
money. I would only suggest Coinbase if you're investing in the coin.
Okay. So what do you
What-
use if you're gonna for like Litecoin and Ethereum and all that?
You can use Coinbase. Personally, I like blockchain.
Mm-hmm.
Blockchain.
Yeah, blockchain.com. I personally really like it. That's what I use. But I've also used Coinbase in the past, and I had no issue. They just held my money for a week, which was annoying. So, has this Zoom helped you guys at all?
Very much.
Oh
Absolutely.
yeah, it was a blessing.
Would you guys like me to do more of these?
Most definitely, sir.
Yeah,
Most
sure.
definitely.
Well, I will definitely try my best to do more of these. And I hope you guys have enjoyed this. I will upload this. It's almost a 2-hour class, but I will enjoy the. I will upload this into my YouTube channel. I send you guys the link on Discord. I'll also send you guys the link for Eagle FX if you guys want it, as well as if you guys want to trade stocks, I suggest Robinhood or Eagle. Both of those trade very well. So
And
yes.
before you close out, you say you're going to send something about the pair correspondence for the Jeep or for the Forex pairs.
Oh yeah. So let me actually write this very quickly for you guys. Thank you for reminding me. So here's going to be the correlations, right? They're going to follow each other generally, not to the pip, but they're going to follow each other generally. GBPs, meaning GU, EU, GCHF, GCAD, what other GBP? GA, GN,
GJ.
AU, NU, GJ. Well, GJ is a little bit of an outlier, but technically GJ, not really, but technically.
Oh.
That's more or less the ones that correlate. They're going to go in a similar direction. So if these guys are going up, expect these to be going down. If these guys are going up, expect the dollar index to be going down. Expect USD CHF to be going down, USD JPY to be going down, and expect Euro GBP to be going down. Okay. Euro GBP, and here's a tip about Euro GBP. Euro GBP is an index showing you where the GBPs are not going to go. So if Euro GBP is buying, the GBP is mostly sell. If Euro GBP is selling, the GBPs are going to most probably buy. Take a screenshot of this, back test it, see if I'm right, which I know I'm right, but go ahead and convince yourself. And you guys can find this a lot of times in the market. Cool? Cool. All right, guys. Well, admins, I'll talk to you guys in a little bit, and I'll format this file and send it to you guys. Okay? And feel free to send this around to your groups. I don't mind. Send it around to the bigger groups. I hope it helps them out somewhat. Doesn't matter to me. The information is yours now. So yeah, do with it what you will. Backtest practice. Remember that your performance is up to you, not to your mentor, not to your team, not to your platform, to you. All right? Good night, guys. Thank you guys very much for watching.
Thank you, Jay.
Hey, I appreciate you, man. You have a good one.
Thanks,
All right.
James.
You too. Appreciate you guys.
All right,
Have a
later.
good one, man.